Hey, it's Darren with Arbitrage Trade, and we are here with Daniel Hopwood for the weekly, most of the time, deep dive with Daniel, and he is the ex wealth. What was your official title? Wealth
I
manager.
was called a business development professional
There you
for
go.
Goldman Sachs
There
Private
you go.
Wealth
Oh, he even
Management.
said their name. All right. Us apes, we have really nice names for Sachs. All right, so let's go ahead and get
I
moved on
mean,
here.
I'm not the people you hate there. We just bought
I know.
ETFs for
I know.
clients at an overpriced
There you
rate.
go. We could talk about ETFs too, but let's talk about somebody who's even much more better here in our world. We just love him as apes. This guy named Ken Griffin. Yeah, that Ken Griffin. And so you ran across a super stonk, uh, I guess, thread that caught your eye, and it was about Citadel and Ken Griffin, etc. And it kind of just, I mean, was it? It was just told fairly. I mean, was it something that seemed pretty fair? Of what I
It
mean, just
was
kinda
uh, it,
educational?
it was quite critical of their. You'll have to remind me what it's called, Darren. The stocks sold yet not purchased or
Oh,
something.
boy. Yes, sirree, Bob. Alright. Anyway, the title of his blog this week was Citadel's Role in Market Dynamics, and it gets into the, dual functions, which I would argue that there's a lot more than just 2 functions, and 2 different positions they take in every single thing, and every play that's made there, but, um I have to remind you of what? What did you say I have to remind you of? The securities bought and sold, but not yet purchased? Is that what you're saying?
Yeah, securities sold, not yet purchased.
We're gonna talk about
Here's
that
a
in a
t-
minute. We're
here's
yeah,
a
let
term very new to me.
oh, wow. Okay. Um, yeah, that's a big one that has come up over the years in our little circle, our little apes crayon circle. And it's because when we do our research, our DD is what we call it. I mean, we dig into every detail, and there's like thousands of people that are doing it. So somebody usually comes across that, and it's just this little bitty line item at each earnings, I believe, and then it's always talking about what the company is not paid for yet. So they're still sitting out there, going to pay for it eventually. Probably not, but they just keep paying interest until it becomes in their favor, in my opinion. But again, that's further down. So talk to
A
me about.
synthetic short, quite interesting
Let's talk
strategy.
about talk about a market maker, and as you put it, their crucial role. I mean, is it really a person or is it just an algorithm?
I mean, they're algorithms led by people, right? And they're programmed in such a way that at particular times, they react to markets as if someone was behind it, manipulating how
Right.
things are going on.
Wizard
But
of Oz.
they are crucial. If not, you'd have people calling each other still on a bartering system. Now, are they fair and equal? That's you know a conversation for a whole nother podcast. But
Yeah.
I think you
Yeah.
you made a note that Citadel is a market maker for 19% of trades, so they're obviously one of the
Yes.
largest market makers in the system. But they have you know a fifth
Exactly.
of the market.
Right. Right. So they do that, and then they provide the liquidity that's needed, and they provide the information, which could be twisted one way or another to benefit them. I mean, there's so many possibilities that could happen in there, that they could really make it like a house game that it's all about they're going to win every single time. Um, and the biggest thing overall, which we love about Ken Griffin, is that he made a statement, that they set the prices of the securities, and I guess kind of they do, but it really sounds a lot like fixing the price, to whatever they need it to. Because I sit and I watch every week, watch options, and this options are so funny because every single week it seems to come all the way to wherever that max pain is. Almost every single week, at least for AMC, for us apes, we see that happen every single week. And so I know those market makers and/or algorithms are doing those put and call options to where it finally ends up right exactly there. And I wouldn't doubt that the algorithms are programmed that way, to buy more calls or buy more puts, blah blah blah, just to get it to where eventually it's they make the most profit out of it because it seems like 95% of the time it ends up at max pain. I would love to see a chart that shows that every week. How many times do they hit max pain, the most profit for the market makers? So when he came out and said, Ken Griffin said that they determine the price based off of what they determine the value of the company is, and they make it happen that way, that to me screams manipulation of a price. So whether or not they do, don't know. That's not my job. That's regulators' job. And that's my big statement on that and why we are not big fans of Ken Griffin. So give me a counterpoint. So I know you will.
I mean, I don't think that they do set the price in the sense that they make the bid ask, right, and provide liquidity to that. Do they influence the price? I'd say so. I think it's pretty hard to argue against that, right? But at the end of the day, what really sets price, I think, is people buying and selling. Much more on the institution side, how ETFs trade in and out. I think market makers have a much larger influence, probably through the role of options, so synthetically how they're affecting the stock, because the way they hedge their book, um, it, it, I think it inherently fixes price to that causes max pain. It's not like a a super malice thing, but if they're providing liquidity and they're a business, they have to make money, right? And everything is going against them. They have to hedge their book in a particular way to not blow up, to be able to still pay out on whatever options are profitable. It does inherently, to whatever degree it does, manipulate the market for the options to end up that way, which eventually affects the underlying price of the stock. So do
Well,
they does
go
he
ahead.
literally go, Tesla should be $200 today? No, but because of all those other underlying factors, they do, set the price, if you will.
Hmm. You're saying that they don't, and he doesn't say that, but I almost feel like they do. I mean, there is a one off a little bit here and there, but I do feel like they just say, "Today AMC shall be 525, and so it will be, and made it be written in the annals of history." And he just
Uh,
goes,
I
"I."
I
It's like I get this vision of him with the button that goes, 525 today."
Yeah, I don't think he's the Wizard of Oz. But,
That's what it feels like.
I do think it's like, okay, like, AMC Tesla is gonna be in this range today.
Yeah, channel. Oh, yeah, absolutely. 100% because you can see, and that's where the whole spoofing and layering comes in. And I hate to throw all this in, but that's what keeps it right in that little area where they needed to keep it, 10K, 10K, 10K bids that's at the above and below. And they just kind of move it with that. And they never, those 10Ks never get filled. It's just crazy how that happens. By the way, that is illegal. I've looked it up. Spoofing and layering is illegal if you can prove it. So,
Yep.
anyway, I just think they all work together to get whatever price they want to, and I think that's what one of the problems we have. I think the brokers are also very, very much in this because, I mean, the funds are going to do whatever they can get away with, and if it means that they continue to go to these brokers who keep throwing out shares after shares they don't have and never located, then they're going to keep doing that until they say no, I don't have any, and I guess you can't blame them. They're just going to play whatever rules that are not the rules, but whatever situation they're given. So, all right. So let's move on to payment for order flow. I think that's a big one, right? Because a lot of retail investors feel like we're getting just pennied to death with these when they sell the. Because I mean, if we're being honest, our orders, retail orders, get grouped and don't see the lit market until it's convenient to, and they get pushed to a private or dark pool, right?
No, they definitely do not get pushed
Which
to a dark
Citadel
pool.
Citadel has one, by the way, too. So I mean, everybody
Oh,
has a dark pool,
all the big market makers have dark pools, but I mean, for a
right?
dark pool, you're like that's the institutional block selling that they don't want you to see. You're getting the market order with 5 cent spread on it or something. I mean, payment for order flow, I always find to be a funny thing because I do think in an AMC type situation, it does make a difference, right? That they're getting that order book. But like, does it really matter when I'm buying my 3 shares of Tesla? Like, no, like, I'm happy for them to be routed wherever for me to get my commission-free trading. Because in the long run, I'm probably making more money doing that than whatever broker or market maker they're sending me to, and for my 5-cent spread on each stock versus paying $5 to $10 for every
Yeah,
trade.
I do think big picture, you're right. I think it's just certain situations where it's, and of course they're near and dear to our hearts, that something just doesn't feel right. The market makers, another thing, I'm kind of going backward a little bit here, but it sort of fits here. Um, well, not really this section, but I just omitted the fact that when you're watching the line and you see, if you have two funds that need to get, let's say they both are going to benefit at a certain max paying profit price, and so they work with each other in theory. And so one fund on the way up will, the prices will get cleared out so they can move it up. And then the same thing on the way down, they'll clear out bids and asks to get down to a certain price just to move the market to where they need to move it. I mean, just watching it, I've seen that happen to where all of a sudden all the numbers have changed and the prices moved down 5 cents quickly, and all the bids and asks were just suddenly disappeared. Or I've even seen it where it jumps over all the prices that were in between. Let's say it went up, let's just say, make it easy, $10 price point at the current point, and let's say it went up to $13, and there were all these asks in between that 10 and 13. The price jumped up or above it, but none of these down here were cleared out. So I mean, I just don't understand how and why that happens. And it could just be because I'm a dumb ape, or it could be that somebody made some good money at the top end on the $13, while everybody else that had their asks in, or bids, asks, were just skipped. I mean, is that market maker, or is that, because you're not, that's also a legal thing I looked up. You can't clear out your bid and ask line to get to a certain price. So you're not supposed to be able to do
Well,
that. So I don't.
I assuming well, I think it depends what kind of orders they are, but, if it's not market, then it's a limit, right? And I think if your limit isn't hit directly, then, like, if it jumps, I don't think it necessarily has to be executed, right? If
Hmm,
your limit order is at $12 and goes from 10 to 13, your limit isn't triggered, um, in the eyes of, the market. That could be wrong. That
yeah,
would be
yeah.
my speculation, is that I hear what you're saying, and is that, like, wrong? Yes, but, that might be the technicality of, like, having a limit order in place, is that if it jumps past your price, then it's not technically executed, and then it's cleared. And then
Gotcha,
also,
gotcha. I guess the biggest, yeah.
if you are a fund, if there are a ton of shorts in, right, you can, like, I think, it's happened with Bill Ackman. I think it happened with Archegos. Like, when everyone realizes that a fund's about to, go belly up, everyone piles in and squeezes, right? So, and that's fund on fund, right? Like, who knows?
That, I think
I doubt
most of,
funds are
this is fun on fun.
targeting.
Yeah, everything's fun.
Yeah, yeah.
Yeah. Well, I just think we, like, if they want to short something, then they will get with it, because you have to have a buyer, obviously, to what you're selling. And if you can just jump down quick by having that fund continue to buy lower and lower and agree not to buy it higher so that the price can get pushed down. And I mean, it could happen. It just really looks like it is happening. But the big thing with retail investors, I think, um, is just transparency. There's so many things that have come up. Reason like this CAT system. I mean, none of them wanted the CAT system to happen, and the CAT system is a transparency tool, if you will, to allow regulators, if they were actually going to regulate, to go back and track who's done what. And they've been fought the entire time. I still don't know where we are now with it, but it seems like everything that comes up that's proposed by the SEC, which could be just virtue signaling, that it never actually gets into play, or if it does get into play, then it's not enforced. So I think that's kind of the frustrations. And Ken Griffin, like you said, he's a very intelligent guy, and so he's going to take advantage of whatever he can. I can't give him fault for that if the regulators are not going to do anything about it. So you just play on the field you're given, I guess.
Yeah, I mean, until things are T plus 0 on the blockchain and anybody can see
Yeah.
it, the lobbying dollars are just too strong.
Exactly, 100%. So the one of the big thing we wanted to do is talk about the before we stop here is the term security sold, not yet purchased. It's a big thing that's come up, it's specifically about Citadel, because at one time they were like 85 billion or some crazy number like that of that. I think it's worked its way down to 28 billion now as of last year. So somehow they've gotten rid of all that in between. Um, but
Well,
just
yeah, so
kinda
so
just
that
do
that actually makes, like, perfect sense.
okay, so just I'll let you take it from here, and then we'll conclude, but, just kinda give your, perspective on that category and what's happening, and as you just said, it makes sense why it happened.
Yeah, so from what I understand is the security sold, not yet purchased is they essentially borrow it from someone else and they sell it to someone else at that price. So they're kind of like an intermediary, right? And they essentially say with a loan that they're going to pay back the other people, right? So they've already netted their profit from whatever, right? So they do that. And when they did that in, I believe this was from 2021, right? So that's when their securities not yet purchased was at, I want to say it was like 58 billion, maybe it was 68 billion. And if you
I could
remember,
have transposed those numbers, yeah.
yeah, yeah, it was, that's when a market was at the top, right? So this is actually a way if, they have whatever insight they have that the market is gonna go down, that it's better not to actually purchase those securities because then
Right.
they're essentially synthetically short that position, right? Because 'Cause they've netted the profit
Synth
on the top
Are you
end,
sure it's
and they don't have
synthetics?
to buy. What?
Did you say synthetic shorts?
Synthetic, yeah.
Yeah, okay.
It means they're not actually technically short, right? They haven't shorted the
Okay.
stock themselves. They're synthetically doing it through, their market making practice of like owning and like selling, right? It's because they can't, like it's not actually short in their book of them making the market for like longs. So it's like a little different. But anyway, so if they have insight into the markets going down, it makes more sense for them to owe someone for the security and then pay them for the security once the
Mhm.
markets drop 50% because they already obtained the original money at the higher price from selling
Right,
it.
right, of course.
So
Yep.
makes them synthetically short. So if they had that insight, that makes sense because they just made, you know 30 some odd billion dollars from not actually like holding the shares in inventory and selling it and buying it back or sell paying the person later at that price. Now it is
So you're saying that
risk. Sorry, go ahead. I'll let you go before I move to
No,
the
no, I
next
was just
point.
gonna say, you're saying that pretty much the 28 billion that's left now, uh, not counting this year, is just all paper. It's not real. It's not like you said, synthetic. They don't really have to pay it, or
They
where's that
do
number
have
coming
to
from?
pay it. Yeah, yeah. So essentially, they still have. They either have the same amount and the value has just decreased enough that they owe less money, or that this is just part of their market making practice, right? And so much of the book is always going to be in existence of through this, right? Because they just realized, hey, there are certain stocks that we believe are going to go down that people want to buy. We'll sell it to them, and we'll just not pay back. We'll have whatever loan because we believe the loan's 10%. We're going to make 40% from our synthetic short, so we'll pay them back later when makes sense for them to make money. Now, this is a dangerous practice because even if you're synthetically short, your downside is infinite, technically
Mhm.
it's the upside is infinite, but their downside of losing money is infinite. And that is why, hypothetically, it's not, it's just rumor, they raised money from Sequoia during that time period
Right.
because they were getting
I remember.
squeezed and potentially going to fail. Because if you looked at their securities, sold, not yet purchased, it was starting to approach their equivalent of
Right.
their revenue. It was
Yes,
about
yes.
10 billion short, which
The
is,
apes were all over
you
that.
know, quite large. So,
Mhm.
it's one of those things where a lot of people are like, "Oh, were they about to collapse?" Right? And now
Yeah,
you
but
have Sequoia, who's the one of the biggest and one of the best performing VCs, now have one of the largest market makers of public equities at the palm of their hand.
yep, yep, absolutely, and I mean, again, we keep up on with that about how close it was, but we know that every single bank seems to be invested in every single bank. So it's in their best interest. I mean, if you go back and you look at the statements on, JP Morgan's invested in Bank of America, which is invested I mean, they're all invested in it's just one big group. So none of them really want the other one to fail because it'll affect them in the long run. So they'll do whatever they can, whether it be just to make deals, lend out so that that doesn't happen. So Citadel, I just don't
Well,
see ever
I
going
I
under
I think this is
ever.
one of those things too where, like, specifically for Citadel, if they collapse, right? Like, you're talking like insane, like, market collapse, right? Like
Yep,
bigger
it
than
would
when
be.
like long-term financial capital caused the Asian collapse in
Yep,
like the
yep.
80s, I believe, right? So it'd
The
be like,
Fed would step in and fund that not happening, whether on the front end or back end, because they would consider that a security issue and put it under that scope of we can't allow the markets to fail because that would become a security issue for the United States, in my opinion. Because Yellen's almost
it'd
said
be
those very words.
it'd be a world issue, right? Because when the US
Oh,
markets
by default, yeah.
sneeze, the rest of the
Hmm.
world gets the flu. And I think, you know, I wouldn't be surprised if Citadel got a little tap on the shoulder and said, "Hey, like, raise some liquidity, or you're gonna liquidate your book, right? Because like, this is like you're gonna take some big losses this year because it's not looking good for you."
And that's the same time he was off buying the Constitution and buying homes for his mom and all these mansions and stuff because it was almost like this
Oh,
to
Darren, that was probably through his hedge fund. All right, that was different.
it seems trying too hard to prove that he's doing fine. That's everything's fine. I'm fine. All right.
Buying the
Well, we've talked
Constitution was
about
pretty
Kenny.
cool.
Yeah, it is. But we've talked enough about Kenny G now, and we've we've pretty much covered A to Z here, and I'm just tired of talking about him. So we're gonna move on and wait. Oh, wait, who are you gonna talk about next week? Like Vlad Tenev? I mean,
We got a request for explaining NFTs.
okay, the man still. I thought those things were like, who cares anymore? I have
I think
about four
maybe
of them.
maybe we'll do it on like blockchain smart contract technologies, and have a little more
There you
interesting
go.
conversation.
There you go. All right, I'll let you get back to sleep or wake up, whatever you do over there at this time of day. Let's see, what
I,
is
I
it?
gotta go get these bees out of the living room.
Oh, that's right. You got to go to the beekeeper. All right, Daniel, I appreciate it. And we will see you next week.
See you next week, Dan.